Accounting Equation Academic welcomes all the viewers to this only educational purposes made. In this class, sharing a little experience on partnership, especially under Income Tax Act 1961, about the assessment of partnership form. A partnership business where more than one person join hands to start an economic activity or earning income which is being shared among its partners in their profit sharing ratio. And the persons who join hands to form this venture, they are commonly known as a partner in partnership form. So partnership form is a separate entity and accessible under Income Tax Act 1961, and all income earned by a partnership firm is chargeable to tax. A partnership firm is a separate entity as defined by Section 2, subsection 31, include person and chargeable to tax and income earned by it. The chapter covers the provisions related to the assessment of a partnership form, including a limited liability partnership, which is a new concept, and introduced a limited liability partnership, passing the Act 2008, and the partnership form is formed under 2008 Act, that is a Limited Liability Partnership Act 2008, which is registered as per 2000 Act provisions. Further form for the purpose of taxation are covered are assessed either as partnership form as such or partnership form assessed as association of person. The tax rate, surcharge, cess, and marginal relief applicable for a firm. The total income of a firm is taxable at a flat rate of 30%. So this total income excluding the special incomes which are taxable at special rates given below. These are the special incomes and separate rate of tax is applicable. If a firm earning long-term capital gain under section 112, then that income is chargeable to tax at a flat rate 20%. And again, one capital gain is there, which is long-term capital gain on sale of shares, units of mutual fund covered by STT, means security transaction tax, and it is covered by section 112A. An amount exceeding rupees 1 lakh, then that income is chargeable to tax using a 10% tax rate. Similarly, short-term capital gain on sale of securities, it is also covered by if security transaction tax STT and under section 111A, and such income is chargeable to tax separately at a rate of 15%. Besides these incomes or different rates, casual incomes are also classified under Income Tax Act section 56 subsection 2 has given the few incomes, casual incomes like winning from lottery, crossword puzzles, card game, horse race, etc. And if the partnership firm earning this income, then it is chargeable to tax at a flat rate 30%. Besides this, if there is any unexplained income which are not disclosed, and then later on that income is recovered and it is came on unexplained incomes, that is here it is 60% rate of tax is applicable. Besides special income, normal incomes are also there and which can be earned by a partnership firm like income from business. And this point number 6, incomes other than special incomes. So then these other than special incomes covered like income from business, income from house property, etc. And such incomes are chargeable to tax at a flat rate of 30%. And not only the flat rate is applicable, again the surcharge is also payable by a partnership firm, and this is calculated on the tax, so calculated above point number 1 to 6. And if total income exceeds 1 crore rupees, then the amount of tax so calculated will be increased by further 12%, by increased by 12% on such tax calculated up to point number 6. The balance amount further increased by 4%, which is called health and education cess, on the amount calculated up to point number 7. So this is the tax liability, how calculated of total income, a brief summary applicable to partnership form. And point number up to 5 is equally applicable to all persons who are defined by section 2 subsection 31. The share of income received by a partner is fully exempted under section 10 subsection 2a, that is the if business earned income and that income is distributed among its partners in their predetermined profit sharing ratio, and this share of profit is not taxable in the hand of partner, and it shall not be included in total income of individual partner. But the amount of remuneration like salary received by individual partner, bonus, commission, etc., along with interest on capital, if any received by a partner, is chargeable to tax under the head business income. Very important point here. So remuneration received by a partner from the partnership firm is chargeable to tax under the head income from business, whereas the share of profit received by a partner from the partnership firm is not chargeable to tax, it is exempted, and it is given by section 10 subsection 2a. Now under Income Tax Act, a partnership firm can be of the following two types. One is a partnership firm assessed as such, that is, if a partnership firm fulfills conditions prescribed under section 184 of Income Tax Act, then such partnership form will be assessed as such. And another partnership form under Income Tax Act, which is if the partnership form does not fulfill the conditions prescribed by section 184, then the such partnership form will be assessed as association of person, AOP. So these things are two types of partnership form. The assessment point of view, the under Income Tax Act, the partnership form is classified into two categories, that is form fulfilling the conditions prescribed by section 184, and if the form does not fulfill the conditions prescribed by section 184, then it will be accessible under section 185. Now here this is given that it is talking about the section 184. A partnership form assessed as such if it fulfills the condition prescribed under section 184. Must have the written partnership deed, which is also commonly used the term instrument of partnership, and that is the partnership form must have partnership deed, and it will get the benefit of section 184. And these are the conditions prescribed by section 184 that a partnership form should fulfill these conditions. So it must have a partnership deed. So partnership deed is a constitution of partnership form, and it contains the details information about the partnership form and the partner's name, address, um, the nature of a business, then the contribution of capital of each partner, their profit sharing ratio, and their entitlement of remuneration, that is the salary, commission, bonus, as well as interest on capital. So that is why it is the constitution of partnership form, and it gives the details information uh, of partnership form, and which is authorized by partnership deed, and within this authority, within this framework, a partnership form has to work, and accordingly the partnership firm can claim deduction on remunerations paid to partners if it is provided, as well as interest on capital if it is provided in partnership deed. So that is why it is called constitution of partnership form, and it gives details guidelines for carrying on business activities of partnership firm. Moreover, the such deed must show the respective share of each partner, that is the profit sharing ratio, and it is duly signed by all the partners except a minor partner. Then certified copy of such instrument or partnership deed should be submitted along with the return of income for the first year to the income tax department. In case there is any change in the profit sharing ratio, a revised deed must be submitted to income tax authority. The form should not have been assessed to tax under section 144, that is, the assessing officer has not used the best judgment assessment. Best judgment assessment, if the partnership form fails to comply with the notice given by income tax authority, like failure to get their books of accounts audited, failure to file the return of partnership form on or before the due date. In this case, the partnership form may get the different notices from the income tax officer or authorities, and if the partnership form fails to produce the documents or fails to produce the documents or fail to presence in person before the assessing officer, then the best judgment assessment is applicable. Assessing officer and determine the tax liabilities of partnership firm. So apart from these are six conditions are prescribed by section 184. If a partnership firm comply with fulfills all these six conditions, then partnership firm will be assessed as such. Otherwise, the partnership firm will be assessed as an association of persons. That is under section 185. Regarding the payment of remuneration to working partner, so here the term working partner, that is the non-working partner, is not entitled to receive any remuneration, and it is disallowed while calculating income from partnership firm, income from business or partnership firm. So if this is authorized by partnership deed, then the partners are entitled to receive the remuneration, but under section T subsection B, clause B here, this is the section given here, authorized by partnership deed. Therefore, the payment of remuneration shall be allowed as a deduction to the firm under section 40B, which is to be calculated as under. So how remuneration payable to partners is to be calculated? Here the rules provided: on the first rupees 3 lakh of a book profit, then 1,50,000 or 90% of rupees 3 lakh, whichever is higher. This will be the amount will appear here, and greater amount here. And on the balance of the book profit, that is the 60% of book profit, the amount will be appear here. So adding this total amount, this one, so this is the limit, and it shall be compared with the actual remuneration paid to the partners, and the deduction is available the least amount, whichever is less. The amount computed above shall be compared with the actual remuneration given to the partners as per profit and loss account discloses, and being a least amount is eligible for deduction as remuneration under section 40 subclause B. So then there is one more terms we got, that is the book profit. So what is the book profit? It is the normal profit and loss of the business, and adding the remuneration of partners, then it is the book profit. So here the meaning definition is given. It means the net profit as shown in the profit and loss account for the relevant previous year, computed as per the normal provision of profit and gains of business or profession, which is to be increased by the aggregate amount of the remuneration payable to all the partners of the firm if such amount has been deducted while computing the profit. All viewers are requested to watch these theoretical discussions, and I am making this class as part 1, and in part 2 an illustration shall be taken to explain all these provisions given and their applicability for while calculating the income from partnership firm, from business. So all these things will be illustrated in part 2 with viewers. So all of you watch it, like, subscribe and share with your friends.